Joining us in a first on CNBC interview is Hugh Johnston. And Hugh is now Vice Chairman and Chief Financial Officer of PepsiCo. I try to keep up with you, Hugh. When did the Vice Chairman title get added? Is that we got to go have a drink?
Actually, Joe, that's not a recent one. No, I picked that one up about 7 years ago.
Oh, my God. Maybe we didn't say it all the time. That's I'd like to be vice chairman or something, but I'm not. Hugh also serves on our CNBC Global CFO Council. What's different this quarter sequentially from the last, Hugh, in terms of, is inflation moderating? Because we're told that it's moderating. Eggs seem to be coming down, other prices that we've been watching.
Yeah, to tell you the truth, Joe, no, inflation didn't moderate at all in the quarter.
Really?
If anything, I think our pricing probably finally caught up a little bit with what the inflation is that we've been facing. Overall, the quarter was very, very strong for us. I mean, 14.6% revenue growth. That's the fifth quarter in a row where we've had double-digit growth. We really feel great about the business. The investments that we've made behind our brands and the fact that consumers really are still pretty healthy in terms of their balance sheets for inexpensive items like our products has caused demand to continue to be strong for us. Combine that with the fact that our customers are working well with us. They just named us the #1 supplier for the 7th year in a row. We really have, I think, a pretty winning formula right now. And obviously, this is one of the biggest weekends for the year for us with the Super Bowl, with a bunch of great advertising with people like Missy Elliott and Jack Harlow and the guys from Breaking Bad, and biggest of all, Elton John, of course. We really feel like we have a formula that wins right now.
Hugh, same kind of questions we ask all the time. Is there any sign that people are trading down for things? Are they still buying premium? You said inexpensive products, and that's true, but you do have premium versus lower priced items. Any trading down at all? Any sign of weakness in the consumer that you're seeing? None.
We don't see that in our business. The one thing we see a little bit of is, for some consumers, they're moving down in the retail chain. So they may have previously shopped at a premium store, and maybe now they're going to a mainstream store, or maybe from a mainstream store to a dollar or a discount store. So you see a little bit of that behavior going on. But in terms of our products, no. Our premium products and our value products are all doing really, really well right now. So I think in a world where consumers have money, but they're also nervous, they'll not buy cars, they'll not buy personal technology, but they will treat themselves to our products because they bring a little joy to your day.
The dividend increase, the buyback. So you're a $235 billion company. $1 billion doesn't seem like a very large buyback. It's going to be taxed, I guess, at 1%, might be eventually 4%. And your dividend's pretty nice, 10% added on to what, 2.4%. Why only $1 billion? Or why $1 billion? Why even do a buyback?
Well, I think the $1 billion is basically going to offset employee stock compensation and other potential dilution that's out there. The biggest piece of the cash return is dividends. We've always been a big believer in growing our dividend. I think we've grown it now 51 straight years. And that's about $6.7 billion. We'll earn $7.20 or so this year, and the dividend is $5.06. So we're bigger believers in conveying more money back through dividends than we are through share repurchase.